Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
February 5th, 2026. Open, $102.69. Close, $103.20.
And the volume?
13,332,077 shares.
Context is everything here. You have to look at the baseline. On a typical day, your standard Tuesday, KKR trades roughly 4.7, maybe 5.9 million shares. It's quiet, it's steady.
Usually.
But February 5th wasn't a standard Tuesday. We saw 13.3 million shares change hands. That is nearly triple the average volume. When you see that kind of liquidity hit the tape on a gap down, that isn't just heavy trading. That is institutions heading for the exits. All at once. That is an exodus.
See, I look at the same numbers, but I interpret the psychology completely differently. That wasn't an exodus, that was capitulation. And there is a distinct difference. An exodus implies a structural exit, a permanent loss of faith. Capitulation, well, that's the moment the last weak hand finally gives up because they just can't take the pain anymore. Look at the chart. We touched $166.13 back in January of 25. Since then, it's just been this slow, painful bleed down to this $99 to $105 range. That volume spike on earnings day tells me the selling pressure has finally washed itself out. The tourists are gone.
I wouldn't call them tourists. I would call them rational actors reacting to a broken trend. You're trying to catch a falling knife here. Look at where we are sitting right now, technically. The stock is trading significantly below its 50-day simple moving average of $127. But more importantly, it is sliced right through the 200-day moving average of $130.98.
Technical levels are fluid.
The 200-day isn't just a line on a chart. It's the line in the sand for long-term institutional trend followers. In technical analysis, when you slice through the 200-day SMA on triple the average volume, the trend isn't just testing support. It has collapsed. The market is screaming that the uptrend is over.
I see the chart damage, of course. I'm not blind to the price action. But you're looking at backward-looking indicators. If you look at the relative strength index, the RSI, we have dropped below 20. That is extreme oversold territory. Historically, when a quality asset like KKR hits an RSI under 20, it signals selling exhaustion. It's a rubber band that has been stretched too far. It is a classic mean reversion setup.
Or it signals that the market has fundamentally re-rated the risk. You mentioned the quality of the asset, but the market is clearly grouping KKR into this broader software route we've been seeing across the sector. Investors are terrified of firms with large technology-exposed credit portfolios. The technicals are telling us that the market believes KKR is more exposed to this contagion than the bulls want to admit.
I think that's a misclassification. You're calling it a broken trend. I call it a market dislocation. The market is selling KKR down, 29 or 30% over the last 12 months because of sentiment contagion, ignoring the actual strategy the firm has executed. Blackstone is down roughly 19%. KKR is being punished disproportionately for sins it didn't commit.
Disproportionate or precise? Efficient markets usually get it right eventually. If KKR is down 30% while Blackstone is down 19%, the market is sniffing out a specific weakness in the KKR model, likely regarding how they are valuing their private marks in a high-rate environment. You can call it a dislocation, but when 13 million shares change hands in a single session, that's a vote of no confidence.
I disagree. That volume was a knee-jerk reaction to a headline number that, excuse the phrase, was essentially fake news. Or at least grossly misinterpreted news.
You're talking about the earnings miss. Let's not gloss over it. This is the catalyst for the drop. Fourth quarter 2025 adjusted net income came in at $1.12 per share. The consensus, what the street expected, was $1.14.
A difference of 2 cents.
It's not just the 2 cents, it's the trend. That $1.12 is a decline from $1.32 in Q4 of 2024. In a year where they raised record capital, earnings per share went backward. In a high inflation environment, if your bottom line is shrinking while your expenses are rising, well, that justifies a sell-off. The market hates negative growth.
That is such a superficial reading of the income statement. You have to look at why they missed. This wasn't operational failure. The entire miss and then some was driven by a single line item, an 18-cent per share clawback obligation related to an older Asia-focused private equity fund.
Clawbacks are a part of the business. You can't just wave them away. It's real cash leaving the firm.
But it's a one-time item. It's a clerical reality of legacy funds from a different era. Think about it this way. If you strip out that 18-cent charge, which has zero bearing on the forward-looking earnings power of the firm, the adjusted net income would have been $1.30. That would have been a massive beat against the 114 consensus. The market punished them for a legacy accounting adjustment.
Maybe. But let's look at the actual business performance.
Exactly. Look at the top line. Revenue hit $5.93 billion.
The revenue number was high, I'll grant you that.
High? It was stratospheric. It was up 76.1% year over year. The consensus was expecting $2.23 billion. They nearly tripled the revenue expectation. This is what I mean by dislocation. The market is dumping the stock because of an 18-cent accounting clawback, while ignoring that the fee-generating engine grew by 76%. That is a massive disconnect.
Revenue is vanity. Profit is sanity. The market is concerned about the quality of that revenue and the cost to generate it. Yes, management fees grew 24% to $4.1 billion for the year, but the complexity of this organization is just skyrocketing. They aren't just doing buyouts anymore. They are running insurance, they are running infrastructure, they are running credit. The expense load to manage that complexity is eating into the margins. That's why the EPS is down year over year, clawback or not.
You're viewing complexity as a liability. In this environment, complexity is the moat. This goes back to Henry Kravis's core thesis for the 2020s and beyond: regime change. We need to spend a minute on this, because if you don't understand regime change, you can't value KKR.
It's a catchy slogan for a slide deck.
It's more than a slogan, it's a recognition that the economic gravity has shifted. For the last 15 years, say 2010 to 2024, private equity was easy. You buy a company, you pile on cheap debt because rates were zero, and you sell it for a higher multiple. That game is over. The new regime is defined by higher rates, sticky inflation, and geopolitical scarcity. To win now, you can't just be a financial engineer. You need to own the actual pipes of the global economy. You need infrastructure, data centers, energy transition, and insurance float.
So they're becoming a conglomerate. They're becoming General Electric in the 1990s. That usually ends with a lot of bloat and a breakup.
They are becoming an index of the real economy. That is why they need to run credit, insurance, and infrastructure simultaneously. It's not loss of focus. It's diversification into the only asset classes that survive inflation.
And that pivot brings execution risk. Let's talk about the spending spree to achieve this regime change. On February 5th, the same day the stock tanked, they announced the acquisition of Arctos Partners.
Which is a brilliant strategic bolt-on. $1.4 billion in initial consideration to acquire a firm with $15 billion in AUM. But look at what Arctos does. They specialize in sports franchises in GP solutions.
It's another layer of complexity. They're creating this KKR solutions platform. But look at the price tag and look at the sector, sports. It feels like they're chasing the hot thing rather than sticking to their knitting. Everyone is buying sports teams right now. Is KKR late to the party?
It's not chasing, it's stabilizing. By bringing Arctos in, they push their pro forma long-duration capital to 53% of total AUM. Do you understand what that does to the valuation multiple over time? More than half of their capital is now permanent or long-dated. They are becoming less of a volatile PE shop and more of a steady asset manager like BlackRock or an insurer. They are locking in the feeds for decades, not years.
That's the narrative. But look at where they are actually deploying the big money. The ST Telemedia Global Data Centers deal.
The STT GDC deal. Correct.
That is an enterprise value of almost $11 billion US. KKR is taking a 75% stake. That is a massive bet.
It is the ultimate AI play. You have 2.3 gigawatts of capacity. This connects KKR directly to the global capital expenditure cycle for artificial intelligence. Everyone wants exposure to AI infrastructure. KKR just bought the pipes. They aren't betting on which AI model wins. They're betting that all of them need power and rack space.
But at what valuation? They are deploying capital into the most crowded trade on Earth, AI infrastructure. They have $118 billion in dry powder. My concern isn't that they can't raise money. We know they raised $129 billion in 2025. My concern is that they are under immense pressure to deploy it, and they are buying at the top of the hype cycle in data centers. If the AI bubble bursts or even deflates, they are holding an $11 billion bag.
I don't see it as a bubble. I see it as essential utility. And they aren't just buying data centers. Look at the HMC Capital partnership they announced. 600 million Australian dollars into energy transition. This fits the regime change perfectly, investing in real assets, energy, and security that track inflation.
It sounds good in a slide deck. Security of everything, regime change. But let's look at how the market is actually pricing this transformation, because this is where the bear case really sharpens its teeth. The valuation multiples are, well, frankly terrifying.
They are premium. There is a difference.
No, they are stretched. Let's look at the history. For the last decade, if you bought KKR, you paid about 22 times earnings. Specifically, the 10-year average is 22.24. Today, based on trailing numbers, you are being asked to pay roughly 44 to 49 times earnings.
Depending on the clawback math.
Even giving you the benefit of the doubt, it's over 40. You are paying double the historical rent for the same house. And let's compare it to the neighbors. Apollo Global Management, they are arguably the gold standard in credit right now. They have massive scale. They are printing money. And yet, Apollo trades at roughly 18.5 to 20.5 times earnings. Explain the logic to me. Why is KKR's dollar of earnings worth twice as much as Apollo's dollar of earnings?
Because not all earnings are created equal. You know this. Apollo is a beast. I agree. But Apollo is fundamentally an insurance balance sheet that takes spread risk. They make money on the gap between what they pay policyholders and what they earn on investments. That is risky. The market always discounts spread earnings because if rates move against you, you blow up.
KKR bought Global Atlantic. They are in the insurance business too. You can't have it both ways. You can't say we are diversified like an insurer to justify the stability, but we deserve a tech multiple because we are an asset manager.
Only partially. KKR is still valued primarily on its fee-related earnings, FRE. This is capital-light, recurring revenue from managing other people's money. The market loves FRE. It treats it like software revenue. But there is also a massive hidden asset in KKR's valuation that the PE ratio misses entirely. It's the accrued income in the insurance segment.
Accrued income sounds like future promises.
It's accounting mechanics, but think of it simply. Imagine you have a check in the mail. You know it's coming. The work is done, but it hasn't hit your bank account yet, so you can't spend it. Management has been very clear. There is $300 to $350 million of accrued income within Global Atlantic that is currently sitting on the books. It is expected to convert to cash in 2026. That income is not in the trailing PE. If you factor that $350 million in, the forward multiple drops significantly. You are essentially buying that future cash flow for free right now because the market is ignoring it.
I'm not sure I buy that it's for free when the stock is at 44 times earnings. Blackstone trades at 42 to 44, so KKR is right up there with the industry leader. But Blackstone has a market cap of nearly $200 billion. They have scale and margins that KKR is still chasing. The market is pricing KKR for perfection, pricing it as if the transition to 53% long-duration capital is already flawless. And when you miss earnings, even by 2 cents, and even with a clawback excuse, you show that you aren't perfect.
They are closing the gap with Blackstone. That's the point. KKR's market cap is now $91 to $101 billion. They are arguably the number 2 player now. The gap in valuation multiple between KKR and Blackstone has evaporated because the market realizes KKR's growth trajectory is steeper.
If the growth trajectory is so clear and the valuation is so justified, explain the insider selling to me. Because actions speak louder than Investor Day slides.
Here we go. You are going to bring up the founders.
You can't ignore it. George Roberts sold $116.8 million of stock in August 2025. Henry Kravis sold $153.7 million in June 2025.
They are effectively retired founders.
They are the architects. They are the names on the door. When the architects are cashing out over $250 million in stock within a few months, it sends a signal. They sold into the strength. They sold before this drop. That suggests they felt the valuation at $160 was pretty full. If they thought it was going to $300, they wouldn't be selling $100 million blocks.
You're interpreting estate planning as market timing. These men have the vast majority of their net worth tied up in the firm. Since the C Corp conversion, the stock has had a massive run. Diversification is prudent, not bearish. It's simply good financial hygiene.
It's a lot of hygiene.
But if you want to talk about signals, look at the buying. That's the signal you should be watching. Look at the directors who aren't trying to manage billion-dollar estates. Timothy Barrackett, he bought $4.13 million worth of stock in May 2025. Robert Scully bought $1.5 million.
That was in May. Prices were different.
They were buying into weakness. They were buying the dip. That signals internal confidence in the operations. And look at the institutional flows. We saw the 13F filings. Fidelity FMR LLC increased their stake by 27% recently.
And BlackRock trimmed their position by roughly 6%.
A minor trim. Fidelity ramping up by 27% is a high-conviction move. The smart money is not fleeing, they are rotating. The institutions own nearly 62% of this float. They aren't going anywhere.
Fidelity might be loading up, but the retail sentiment I'm seeing and the technical breakdown suggests that the smart money might be early or wrong. When I look at the chatter, investors are torn. They see the high dividend yield of the sector generally, but they see the specific breakdown of KKR. The narrative is messy.
Confusion creates opportunity. Let's circle back to the core thesis. You have a company that just grew revenue 76%. They have successfully shifted their business model so that over half their assets are long duration, meaning they are locked in. They have the dry power to capitalize on a distressed market, and the stock is trading with an RSI under 20. That is a coiled spring.
And I see a company trading at double its historical earnings multiple during a software and credit rout, while its legendary founders are selling 9-figure blocks of stock. The earnings miss, while technically driven by a clawback, reveal that expenses are rising. And this regime change into infrastructure and insurance creates execution risk. If they overpay for one or two of these massive data center deals, that 44 times multiple is going to compress very, very quickly. Gravity is a powerful force, and right now KKR is defying it relative to its peers like Apollo.
Gravity applies to old world businesses. KKR is building the infrastructure for the new world. AI, energy transition, private wealth. You mentioned the software route. I believe that is the market mispricing KKR's credit book. They aren't holding vaporware, they're holding asset-based finance. The sell-off is a gift.
A gift or a trap? That's the question. If you buy here at $103, you're betting that the technical trend is wrong and the fundamental regime change story is right. But you are fighting the tape. The 200-day moving average is $30 overhead. That is a lot of resistance to chew through.
And if you wait, you might miss the snapback. When that accrued insurance income hits the books in 2026 and the market realizes the cash flow power of the STT-GDC deal, we won't be talking about a PE of 44. We'll be talking about earnings growth catching up to the price.
We will see. For now, the tape says, caution. The dry powder is great, but only if they find something worth buying that isn't priced for perfection.
They found Arctus. They found STT-GDC. They are deploying. The machine is working.
Let's hope the machine can justify the premium, because right now the market is demanding proof.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.